It's very good education.
The options market is liquid and fundamentally, even if you've got high prices,
Let's just
sellers.
Omega.
So if I've got high implied volatility, options traders are going to come in and sell that implied volatility. And when you have sellers of a high-priced item and not as many buyers, what happens to the price of that item? It goes down. So high implied volatility is met by selling pressure. Low implied volatility is met by buying pressure. Implied volatility tends to be mean reverting. It tends to come back to the middle. So what are some reasons why implied volatility, or in other words, demand for options, might go up? Somebody said it starts with an E and ends with earnings.
Dividends.
Earnings. Because that's a known unknown. I can't schedule news events other than an earnings announcement. I don't know when news is going to come out. But I do know when the next earnings announcement is going to be. So that's a known news event. I don't know what the results are going to be. And I don't know how it's going to impact the price of stock. But I know when it's going to be in the calendar. So earnings is one of the things that drives stock prices. Earnings is one of the things that drives stock prices. And the potential for movement of the stock price is what drives implied. So, Ray, flip over to that other screen that you're working on that side and show that chart of Apple. Go to my chart tab. So go to there you go. Show the chart of that stock. And down there at the bottom, you notice that Apple's been going up. This year, there's been 1, 2, 3, 4, 5 earnings announcements. Just back off the left-hand side there. Each one of those things in that chart, that's an earnings announcement. We just had one a little bit ago for Apple. Now look at this chart that's down on the bottom. That indicator that I've got down on the bottom is implied volatility. The average implied volatility for the option on the stock. Implied volatility is it's not actually happened in the past. It's expectation of movement. Every time we have an implied volatility goes up into that earnings announcement. And then what happens after the earnings announcement? What direction does that graph go? Back down. Why? The unknown is now known. So there's not a demand. Plus, that high implied volatility value that inflated those option premiums was met by sellers. Option sellers came in and sold that high implied volatility. And then when the news came out, boom, that implied volatility crushed. Here's what happened to my dad and his friend with that Seagate technology trade. They got the direction right, but they held it all the way till expiration. So they lost all the time value that they had because of that time decay. And they bought it. They bought that long call option when there was an anticipated event in the future. What do you suppose was happening to demand for those options? It was going up. They bought a very inflated option from an implied volatility standpoint. The news announcement came out, the product announcement came out, price of stock went up, but implied volatility crushed. It just went way down. So all of that implied volatility value in that option premium got sucked out of that option premium. So they lost on time decay, they lost on implied volatility. They bought an out-of-the-money option that didn't have a high delta, so they didn't have a high probability of success, and it didn't have any intrinsic value. Now, the price of stock moved. They ended up with a little bit of intrinsic value, not very much at the end of the lifespan of that option. So, if you are, in general terms, and then we're going to kind of wrap this all together, if you are the buyer of an option, and you want the option premium that you paid for to go up in value, do you want implied volatility to be high and falling, or do you want to start out that trade with low implied volatility that's going up? Low and going up. Because if the price does nothing, but implied volatility goes up, that could increase your option premium. So, let's flip that over. If you are the seller of an option to begin a transaction, Do you want implied volatility to be low and rising, or do you want implied volatility to be high and falling? Because if implied volatility, you want it to be high and falling, because if you sell that inflated premium and now that implied volatility crushes, cool. I sold an option for $2. Time passed, which worked in my favor, and implied volatility crushed, which worked in my favor. And now I can buy that option back for 20 cents. Cool. That's a higher probability trade. Selling an implied volatility or selling the passage of time is a higher probability trade than picking the direction on a stock to be sure. Just objectively, being the seller of an option likely carries with it a higher probability of success. Because you're selling out the money when the stock's not likely to be. You're selling at a time when time decay, the inevitable, is working in your favor. And you are selling, hopefully, when implied volatility is high and falling. But you don't always know the way, do you? So the reason we talk about all of these option Greeks in the way that we do is because you, as an option trader, and I can't be there with you when you press that button to buy or sell your option. You, as an option trader, have to make that decision. And this is where behavior becomes the biggest factor in option trading and trading successfully. Because if you are greedy, if you think I'm going to buy cheap out of money options because, wow, the stock's going to make a big move, and you do it with a little bit of time to go until expiration because they're cheaper, and you do it when implied volatility is high and falling, wow, you're putting yourself in a position where you can take a loss pretty quickly. That's where that greed comes in. But if you're putting yourself into a likely scenario of success, uptrending stock, buying a call option that's in the money, it's got some intrinsic value, and buying enough time that it lets the stock do what it's going to do, and you buy when implied volatility is low and rising, now you have a greater possibility or probability of success, especially if you couple it with that uptrend. Put yourself in a starting point and risk in your trade along the way. If you're the seller of an option with higher implied volatility, shorter time frame, directional movement against what you're selling, put yourself in an area of higher probability of success. You're not going to win every trade, I promise you. You're going to have some losing trades, and it is okay to have a losing trade. That's the reason why we talked about managing your risk yesterday and how much you're willing to risk in any one particular trade. So now what we're going to do, after we understand these option Greeks, and Ray's showing them here on the option chain as we've been looking at this, what we're going to do this afternoon is we're going to talk about putting these together in strategy trade.
I got up here on the screen real quick how to put that implied volatility graph on your charts. Just go to the Hermano flask like we showed yesterday, and just type in IMP. You'll see it right there, implied volatility. All right, double click it, it goes into your onto your chart, and there it is. So you can give you a kind of a midpoint of where it is. It shows you if it's rising, or right now currently it's what, falling, right? Now, as Ben said though, is every time you're going to pull up the chart, you're going to have that perfect, wonderful world where you're going to want to buy an option, volatility is low and rising? Not always. All right? Does that mean you should not do the trade? No, it just means what? Understand that you might not see gain in volatility that you'd like to see. Does that make sense? Okay. So there's understanding the why now on the Greeks help you understand how premium changes now when the underlying of the stock changes. Yes? A little bit? Does it help a little bit? Yes?
Yes.
So when you go home now, you're not just guessing going, oh, which strike do I pick? Right? Now you have an idea. Well, if you pick this strike, what could happen to it?
Last thing I think about option Greeks is this, and as it relates to what Ray just said, I can't count the number of times that somebody's has come up to me a workshop and asked me this question. Ben, what's the best strike price and time frame to choose?
Yes.
There isn't one. There isn't. Just like there's not one best technical income. There is not one best strike price or expiration to choose. You choose the one that mitigates trade that you are faced with. It's always a trade-off. There are, other than the passage of time, moving forward in time, there are no other absolutes in option trading. There is no absolute best answer to the question, what strike price and what expiration? Pick the strike and expiration that makes the most sense for the factors that you want to do, and go from there. And then manage your risk, because that's how we do it. Now we're going to put it into strategies. Ray, great job. Let's give Ray Kimbrell a big round of applause.